Good afternoon. My name is David Levinstein, executive producer at 103.9 LI News Radio, and I'm sitting in the studio with Jan ten Haagen from the ten Haagen Financial Group. He's the portfolio repairman, and this broadcast can be heard every Saturday at 12:30. Visit Jan ten Haagen in his office. He has an office in Huntington and Northport and in Manhattan. His email address is tenhagen.com, TenHaagen, tenhagen.com. If you haven't begun investing, this is a great time. Even though the market's at its high, Jan, right? I know I've spoken to some people, off the show. We talk about investing. Everybody does nowadays.
Of course.
And they go, "Oh, it's too high. I'm going to wait for the market to come down before I step in." How big of a mistake is that?
It's probably one of the biggest you can.
Right. That's it's people trying to time the market, explain what an awful idea that is.
Well, as we said in the last program, the biggest mistake is not starting.
Right.
And if you start now at the high, okay, so it's a little slower than if it was the bottom, but
Right.
I don't know anybody that can pick the bottom or the top.
Right.
So people back in 87, get me out, get me out, get me out.
Mm-hmm.
When do you go back in?
Right.
The market tanked on Thursday, Friday, and Monday. Mm-hmm. It flattened Tuesday and started up on Wednesday. So
Right.
And back then you didn't have iPhones and all that.
Right. And it closed at the end of the year higher than it was.
Yeah, it was about 3% higher at the end of the year from January to December.
Right. So it's still, we still had a decent year, though people lost in the short run a lot of money.
Right. And then this last one from 08-09, in 13, the market was up 60%.
60%.
However, inflation was 18%. So now the market from 6,500 to 18 plus is about 150%.
Right.
And inflation has been between 22 and 25%.
Right.
So you got to look at both of them.
Right.
But if you had gotten out, and I have people that did, just get me out, and I talked them getting back in before the very top again.
Right.
But still, they lost so much time and potential.
So regardless of the price of the market, people have been telling, if you watch CNBC and go back, they've been telling you since the market hit 15,000 again, that it's overbought. And they told you that at 16 and 16.5 and 17 and 17.2. And after the Brexit vote, they thought the market was going to spiral down, how it's going to affect the finance market. And yet it has done nothing but continue to grow because people still have a lot of confidence in our country and our companies.
Well, our companies are fairly strong.
Yeah.
Their bottom line is getting stronger. We're
Right.
not in a bull market,
Right.
but it's a stable market.
Even though certain politicians talk about how America is hurting right now, these companies that make our stock markets grow are multinational companies.
Sure.
That have a percentage of their business in the U.S. and a larger percentage out of the U.S. because the U.S. is just one country out of many.
If somebody goes to the supermarket,
Yeah.
go down the shelf and pick up a familiar product,
Right.
turn around and see where it was made.
Right.
You'll be shocked at how many are not made in the United States, even though it's an American company.
Right.
So.
And we're talking about food products too. Hey, go into the produce section. And I'm not talking about Whole Foods and things like that. Go to the produce section. Fruits from Chile and other parts of South America. There are I grapes from Chile all the time. I find them to be delicious.
There are foods, the steaks, the meats, everything is from all over the place.
All over the world. I'm talking to Jan ten Haagen from the ten Haagen Financial Group. He's a certified financial planner. He has over 30 years in the business. He has held his clients' hands through markets thick and thin, and he can do that for you too, whether you're investing for a while, you're a seasoned investor, or whether you're just beginning to invest. There's no better person to go to than someone who's been there before. Jan ten Haagen, the ten Haagen Financial Group, TenHaagen, that's TenHaagen. He has offices in Northport, offices in Huntington, and offices in Manhattan. Northport's a gorgeous town. Go out for lunch, stop and see Jan. Go to Huntington, go out for lunch, stop and see Jan. This is what you need to do to secure a financial future for yourself. Let's talk about the difference. We brushed on it in the last show, but let's really get into it. The difference between spending time in the market and timing the market, which we were just talking about.
Right.
Right. The market's at 18,000. Too high to get in. Don't want to get in right now. I want to wait till it comes down.
Well,
how far?
Let's just look at the S&P 500.
Okay.
There are 500 stocks, all in the United States, of course.
Right.
I don't remember a day in the 30-some-odd years that I've been in it that every stock has gone up
Right.
that day.
Right.
So there are things to buy that aren't at the top. So take a look, talk to your financial advisor, make sure that you're diversified. I mean, if you're buying 5 or 10 stocks, it's
Right.
like buying a pile of bricks.
Sure.
But if you buy a mutual fund or a managed account, it's like buying a finished home.
Hey, there were investments back then, when I can remember, back in the early 90s, that were designed specifically to find those particular, lower laying stocks. There was an investment years ago called the Dogs of the Dow. I don't know if you remember this.
Sure.
Which were, out of the 30 stocks in the Dow Jones Industrial Average, invested in the 10 with the highest yielding dividend. Not the highest paying dividend, the highest yielding dividend. And that represented the 10 stocks that were underperforming the others. And what a brilliant investment idea it was, because people made a lot of money during that time.
For a number of years, yes.
Before they started to have other types of companies represented in the Dow. The Dow changed its personality. So therefore the investment changed too. But when the Dow had value stocks in there, it was really a wonderful investment actually at that particular time.
I had a broker when I was a manager for a major firm out east. He did the Dogs of the Dow.
Dogs of the Dow.
Which were the 10 worst performing for the year.
Sure.
He'd buy those, and for quite a few years, they moved up very handsomely.
Right.
But that, like anything that's a segment, eventually fails.
Right. But but finding value is what he's speaking about. But the most important valuable thing you can do for yourself is to spend as much time in the market as possible by beginning at a young age. Explain that.
The sooner you can start, the longer the amount of time you have to succeed.
Right.
And it just makes sense. Get in when you're young,
Right.
even if it's only small amounts.
Right.
But over time, as you earn more, you can put more in. Then you're going to get to a company that now have matches. They didn't have matches in 401ks 20 years ago.
Right, right.
So now you do. And think about it. If they're doing one of the matches where they match you to the first 3% and then half of the next 2%, et cetera, they're giving you an 80% return for no risk whatsoever.
Right.
So look at your 401k carefully. If they have a match, you can't
Take advantage of it.
You can't be dumb enough not to do it.
Yeah, it's free money.
Exactly.
They're giving you money to participate in the plan.
Right.
This is what they're doing. They're giving you money just for your participation in the plan, similar to some stocks out there pay dividends. And they're paying you a dividend if you simply hold on to there's stock.
And there's companies out there that have dividends. They have increased each and every year for the last 10, 20,
Right.
30, 40 years.
Right. Imagine owning a stock that pays you to own the stock. That's a stock I want to own.
Right. And,
Yeah.
if you look at ones that are consistent, you're going to get that consistent added
Right.
growth or income on top of the growth
Right.
of hopefully the company as it improves itself.
So imagine opening an investment portfolio with Jan as a young person. If you're a 20-year-old, or if you have kids that are 18 plus and they want to open their own investment accounts, open it with Jan. Buy those type of investments that pay you to hold them on top of their own capital appreciation over time, and the dividends that they pay. You have an opportunity to possibly create a tremendous amount of wealth for yourself over time. That's the key. The key is that disciplined approach to investing, right?
The key is time in the market.
Time in the market. And there's a discipline. If you're saying, I'm going to save $400 a month, $300 a month in a market, do it. Do it now. Start at 20 and do it until you're 60. That's 40 years of $300 a month. You can only imagine the opportunity that you're leaving off the table if you don't do that.
Picture this, and this might help you to get going on it.
Sure.
A couple retires at 65.
Yeah.
And it's ludicrous, but let's say it costs them $10 a meal per day. That's $30 a day.
Yeah.
Times a year of 365.
Right.
Times 15 years. This is going to cost over $500,000 just to feed yourself.
Right.
No clothing, no vacations, no travel, just feeding yourself. So start early, even if it's a small amount and you think it's not going to add much.
Sure.
It will definitely do that.
It will. I'm speaking with Jan Haagen from the Haagen Financial Group. His website is TENHAAGEN, Haagen. He has offices in Huntington, in Northport, and in Manhattan. He's the portfolio repairman. He's on every Saturday here at 12:30. He is a certified financial planner, retirement income specialist, wealth management specialist, and investment and insurance consultant too, which I want to talk about when we come back, the importance of
Yes.
insurance as well. This is David Levinstein. This is 103.9 LI News Radio. The name of the show is The Portfolio Repairman. The host is Jan ten Haagen from the ten Haagen Financial Group. This broadcast is heard every Saturday at 12:30, and we will be back right after this short break.